Greetings, my name is Kevin Matthews and I am the tax professor. Welcome back to class. Remember, class was never out of session because the learning never stops. Today we're going to talk about deferred and like-kind exchanges. And so what a deferred like-kind exchange is, you'll sometimes hear about these. They're called 1031 exchanges. Actually, under the most recent tax law, a massive change took place with a lot of these. You know, I'd say in the old days, but it's only been a year, so I don't think that really qualifies for the old days. You can do 1031 exchanges on a whole lot of things. There were certain things that you couldn't do them on. So for example, if I have a car outside and it's owned by my business, and I want to go ahead and I want to swap it for a new car, I can do a 1031 exchange and defer the gain on that car. And then what that would allow me to do is sort of avoid, not really avoid paying the tax, but just defer that tax until a later date. Because the way the IRS kind of looks at it is, I have a glass of water in my hand, you have a glass of water in your hand. And I say, hey, I'll give you this glass of water for your glass of water. And you go, okay, that's fine. We swapped. Economically, is anything really taking place? No. I still have water, you still have water. It's H2O, two hydrogens, one oxygen. I mean, it doesn't really change any. Unless we go to another planet, we find out that water is somehow different. But economically, we haven't really changed anything, and as a result of which, the IRS has and had a system that would allow you to defer a lot of that gain until an economic situation had taken place. And the reason why I say this is that 1031s used to be a very, very broadly accepted form of transaction. A whole swing of people could do them for a whole swing of reasons. You do 1031s on your houses in the good old days. They got rid of that back in 1997 when they passed what they call the 121 exclusion, which allows you to exclude up to $500,000 of gain on the sale of your house if you're married filing joint, or $250,000 if you're any other filing status. And so one of the reasons why they did that, of course, is because they were just radically changing the way that houses were being taxed. And I think they did it in a good way, in my personal opinion, but again, it's my opinion. It used to be, up until about a year ago, you could do, like I said, deferred exchanges on darn near anything. Now, we used to make jokes in the accounting world, what couldn't you make, 1031s on? And a very good example of that was if you were going to switch a cow for a bull, the IRS basically said that's not a 1031. And one of the reasons why is because in order for you to have this 1031 type exchange, it had to be like kind. Now, the definition of like kind was defined by the IRS. Okay, very good example. If I want to swap land for a building, like kind. If I want to swap, my red car for a blue car, like kind. No problems. If I wanted to swap a pickup truck for a racing car, not like kind. And the reason is that the purpose of the two are very different. Another good example, and I told you the female cow for the male cow, or not male cow, but the bull. Bulls have completely different purposes on a farm than cows do, okay? And they do different things. And so, could you swap a chicken and a rooster? The answer, a hen and a rooster, and the answer is no, because, of course, the hen lays eggs. The rooster, of course, wakes you up at 5 o'clock in the bloody morning as he's, kind of doing his thing. And if you ever lived on a farm, like I have it a couple times, you know what I mean. So it's just one of those things that, you have to have like kind. Going forward from 2018 going on, the rules have really significantly tightened up on these. Now you can only do these on real property. All right, so if you want to sell a house and buy another house, and your house is used in either a trade or business or what we call a production of income. Production of income is under Code Section 212, and then the trade or business is under various code sections. Code Section 162 is very common because that's where we talk about the ordinary necessary business expenses. But basically what ends up happening is, if you want to do a trade or sale, it has to be part of that business. You can't do these for personal sales anymore. So like I said, if I own the house for myself, I can't do 1031 when I'm selling the house. Now, the good news is you got something even better. Instead of deferring the gain, you can exclude $500,000, which I think is a much better deal than doing the gain deferment. But say, for example, you have a house and it's been a rental property for many years, and you want to sell that property, and you want to go out and you want to buy some. or buy another property, or buy many properties. You can do a 1031 that way. You can do what we, and in fact, I've worked in the past helping people out with multiple splits. I've seen, 2-for-1 split, 3-for-1 split, 4-for-1 split, where basically what ends up happening is you're selling the house, taking the money, transferring it over to what's called a QI, or qualified intermediary, and then you're going out and you're buying some new property. And that is a typical 1031 that you can do. Now, there's tons and tons of ways to do this. And these are also sometimes referred to as starker trades, or starker trades. So we call these starker trades. And sometimes you'll hear what's called a reverse starker, which is basically where you buy the property first and then you sell this one. And if you do it with a qualified intermediary who can handle it, you can still get the deferment of the gain, but you have to play within these specialized rules. Today, I'm really only going to focus on the standard 1031, what we would call the starker. If you are dealing with anything else that's more fancy than that, leave a comment in the comment box below, or send me an email at www.betasolutionscpa.com. That's www.betasolutionscpa.com, and go to my website. There's an info address that you can drop in, and I'll answer your question as fast as I can. So what is required in order to be able to do this? So in order to do this, there are certain gateways that you have to hit. The first gateway is when you are getting ready to sell the property, you will sell the property. After you sell the property, you have 45 days to locate the new property that you're going to do. And that 45-day window can't be busted. You have to report to the qualified intermediary, we found the property that we want to buy, it's here. All right? Now, once you've located that property in 45 days, you have 180 days from the date of sale to close on that property. And if you go to 181, you're done, and you're going to have to recognize all the gain. And the qualified intermediary, one of the reasons why they get to be called qualified intermediaries is that they are qualified and they will report it, okay? So don't try doing any of this fancy, slicky stuff where you're saying, hey, look, or at 181, let things slide. They're not, and they shouldn't, okay? You want to make sure that you're doing these, and if you do these right and you set your chess pieces up correctly, they go pretty fast and pretty smooth. But there's an old saying that a friend of mine used to always say, no good plan survives contact with the enemy, and so obviously there's going to be problems that you're going to run into. And so what happens is that these are the gates that you have to hit, the 45-day and the 180 days. Now, you could, in theory, say, for example, you say, well, Kevin, I'm pretty sure that I want to buy this property over here, but what if it falls through? Okay, well, then that's why we want to identify other properties. And the IRS actually has a procedure that allows you to do this, where you can identify up to 3 properties for every one that you're going to actually purchase. And so, for example, if I'm selling my one house in Florida and I'm buying another house in Florida and the prices are generally about the same, I can choose up to 3 houses during that 45-day window that I say, these are the 3 houses that I'm interested in purchasing. I have to close on one of them in 180 days from the date of sale of the original home. If I get all that stuff taken care of, I'm golden. I don't have to worry about the other 2 properties. Now, I oftentimes get asked, what if you're doing a 2-for-1 or a 3-for-1 or a 4-for-1? Then you can take that number, divide and multiply it by how many ever properties you're actually going to buy. So if you're going to do a 3-for-1, you can identify up to 9 properties. Okay, 9 properties. I want to make sure I got the right number of fingers up. If you choose those 9 properties, you close on 3, you're good. And that's one reason why I do tend to like doing 1031s with multiple properties if you can get away with it. Gives you more flexibility and gives you more options in terms of how to deal with certain things. Sort of talking a little bit about this, there are definitely some other things that we need to talk about, and one is about a qualified intermediary. We're going to talk about qualified intermediary more in detail in another video, so I'm not going to talk about them too much, but you do have to work with one if you're going to be doing a 1031. Talk to your realtor. They probably know some very good ones, as they're always, I'm a member of 2 realtor associations. I get bombarded, frequently from people asking me, hey, you know, would you refer me out to people, blah, 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 blah. And I've got a few that I've worked with in the past that I would be very happy to recommend to people. So if you have a need for a qualified intermediary, send me an email at that info box and we'll get that taken care of. So that's all I'm going to talk about for deferred like-kind exchanges. My name is Kevin Matthews. I am the tax professor. Remember, class is still in session because the learning never stops. If you have any questions for me, like I said in the past, go ahead and fill it in the comment box below. If you want to reach out to me and get more personalized attention, you can go to my website at www.betasolutioncpa.com. Once again, that's www.betasolutioncpa.com, and you can go ahead and you can send me an info email, and there's a way to get that done through the website. Again, thank you very much for watching.